Hello and welcome to Critical Line Item. My name's Tom Ravlick and thank you for joining me for this particular podcast. Today's the day when there's a Melbourne Cup field of analysis from the banking sector from everybody literally looking at the financial services sector and its progress during the past 12 months in the COVID space. There's a lot of issues that the banking sector has faced, including periods when people were given time to not have to pay their loans because of a lack of income coming through the front door and a range of other things. And to talk about the EY perspective of the actual past 6 months in the banking sector, I've got EY Oceania Banking and Capital Markets leader Tim Dring with me today. We'll go through some of the key indicators, but also touch on some of the compliance issues for the banks that have existed in the past 12 months. Tim, thank you for joining me again.
Great to be with you, Tom.
Now, if we look at some of the key areas that you've focused on in the report, you say there are $3.8 billion in combined headline cash earnings across the key banks, across the four major banks, $5.3 billion. From 2020 half-year results. That's an increase of 62%. Take me through what contributed to that.
Yeah, sure. Look, it's not a bad outcome, Tom. We're sitting here almost 12 months on, if you like, from when the banks released their half-year results for 31. Based on the 31 March half-year. For most of them, albeit CBA reported earlier at 31 December. But, an increase of 62% is a pretty strong result given the uncertainty that was, on our doorsteps 12 months ago. And that's driven by, I think, a few fundamental things that have driven that. One is when we look at how much the banks put aside 12 months ago for potential credit impairments. And most of that was around the collective provision. So the forward-looking provision, if you like, Tom, and collectively they put on their balance sheet and through their profit and loss statement $5.7 billion. Now that was based on, I'll call it best case, worst case, and the base case of a number of economic assumptions that may play out. And back then, I think we were talking around COVID. Was it going to be a quick recovery? Was it going to be a U shape? Was it going to be a W? All of those sorts of predictions. So no one really knew. But what they'd sort of built into that provisioning was pretty pessimistic outlook on unemployment. Base case might have been and worst case somewhere around 10% unemployment levels over the next 2 to 3 years. There was also a situation of GDP growth that was forecasted to be a lot lower than where we're at the moment. And house prices in particular, as you know, given the focus on housing, that underpins a big part of the balance sheet and collateral of the major banks, was predicted to fall. So we sit here 12 months on going, actually, a lot of those factors haven't played out like they thought they would have, hence why the banks have started to release some of those provisions they put aside. And in aggregate terms, right across the four banks, and even CBA is included in that mix as well. And it'd be interesting, what their result is when they report their year-end results at June. But we actually had a combined write-back of just over $100 million. As I said, conversely against the $5.7 billion that went through the P&L. So that's been one of the major factors that's increased cash earnings. The other one too is loan growth, and it probably, a lot of the major banks are tracking at or below system, and system has been running at about 3%. But they are, there is modest loan growth coming through, and perhaps the pipeline looks even more promising for the major banks with the applications that are in the pipeline. So that's the other side. Margins have held up reasonably well, albeit they have, fallen again compared to this time last year by about 6 basis points. But over the last few months, we've seen margins starting to pick up as products have been repriced. But, for the banks, the cost of funds at the moment is very low. and it probably record lows cost of funds. So in a low rate environment, margins are compressed, but for the last 10 years almost, we've had a gradual decline of net interest margins across the sector. So we are starting to come off the bottom. The other factor, probably the last one, Tom, that I think has assisted in this this improvement in earnings is underlying costs. Now, operating costs for the major banks have fallen by 4.7% from the prior corresponding period. So, and also, cost to income ratio is down from 53.1% to 50%. So that's a really good news story. And that's off the back of, different operating models. They've had to gear up with certain, an increase in labour costs and headcount to cope with the influx of new loan volumes. But also at the same point in time, continue to invest in technology and automated processes to try and drive that cost down even further in future periods. So to me, those three factors have really underpinned the strong performance that really wrapped up this week.
One of the things that comes through in much of the coverage over the past 12 months is the issue of what happens when JobKeepers stops and some businesses regrettably fall flat on their face because they're not able to sustain themselves. Is that something that's been raised with you by clients?
It's a big feature, Tom. If I look at when the deferral regime came into play, if I go back and the heights of those deferrals, and I'm talking small business and mortgages here, and residential mortgages, about 10% of the total loan book was on a deferred basis. Now we sit here 12 months on, that process has wound up. Banks have either had to have conversations to either restructure those loans that aren't performing or alternatively move them into hardship. But the majority, when I say the majority, well in excess of 90% of those customers that were taking advantage of deferrals are now back making repayments again. So we're now left with only 0.5%, based on the last statistics that came out from APRA in May of this year, that only 0.5% of total loans have been deferred. So, based on the February statistics, so that's a really good news story, and I think it's demonstrated APRA's ability to work with banks and the bank's ability to again work with their customers. But there's no doubt there's some pain in that portfolio, Tom, and that's why there has been a release of provisions, but there is still, I'd say, a cautious outlook still for some sectors, most notably, hospitality, travel and entertainment, transport, in particular aviation, due to not only Australian borders being closed, but the flux and reopening and closing of our state borders too.
Yeah. Now, a couple of things that might be useful to define for people, because when we talk about bank results, we use some funky terms. Obviously, when we began our exploration of this, we used the phrase combined headline cash earnings. What does that mean to the person out there listening to this podcast? Because some of them, they might be familiar with the notion of a profit and a loss, but what are combined headline cash earnings?
It's a good question, Tom, and I think we have seen a convergence, if you like, between the cash earnings number and statutory profit. The two are more coming in closely aligned. And if I look at the results this year, we've got aggregated cash earnings of 13.7 billion versus against a statutory profit of 13.4 billion. So they're actually pretty close, and they haven't always been that close. And it's because the banks have wanted to strip out historically, I'll call it some of the non-cash items, or the one-off items, whether it be some various write-downs that have occurred in portfolios or IT systems, etc., that really don't affect the underlying cash earnings of the bank. They don't go through the cash flow statement, but they are required to go through the profit and loss. Hence, you do have this difference. But over time, those numbers have become closer and closer, and I think that's a trend we're not only seeing in the banking sector, but across most of the other companies that do report cash earnings and statutory earnings, Tom.
Is that because accounting has moved more closely to focus on, I use the term loosely in this conversation, I know, but that are more of a market value focus?
Yeah, look, I think that's right. And certainly ASIC, it's been an area of focus for them, certainly a few years ago, that, in monitoring how companies report, they didn't want cash earnings to be more predominant than statutory earnings. So as a result, you've seen this convergence, and it's always important when companies do report, and you see this through their earnings announcements, that they always either start with statutory profit and reconcile to cash earnings, or cash earnings reconciling to statutory profit, really to provide the users with more transparency. Historically, analysts were really only interested in cash earnings, and that's why banks had, that had been their bigger focus. But we've seen that convergence, and ASIC has really been the sort of watchdog and policeman on that one.
Now, there's a part of your commentary today that also focuses on prioritisation of sustainability as an issue. Where does that fit in with all of the COVID-19 stuff and the issues of metrics?
Yeah, that's another good point. I think we are seeing shareholders, customers, be more in tune with the ESG agenda, the environment and sustainability agenda, Tom. And as a result, we've now got regulators very much focused on making sure that regulated entities are being mindful and conscious of the risks of climate change, not only on their business, but also on the business of their customers. And, we are starting to see the banks, and you can even see it through the reporting information that's coming through this round, a far greater focus on ESG metrics, on what types of customers, banks are banking on both sides of their balance sheet. And just making sure that is reported with transparency, and setting themselves some targets as well for their own carbon footprint for their own business. So you'll see a stance being taken around how much they will lend, and their position on what they will lend and who they will lend it to, Tom. And I think that is going to change. But it's also about educating customers and banks too, that policy is changing in this space pretty quickly, and particularly in their institutional bank for some of their big global customers that are exposed to different jurisdictions. The pace of change in government policy in this space is pretty fluid, so they do need to be attuned to it. We're also starting to see, banks work with their customers and helping their customers navigate the ESG agenda, and looking at what customers may be vulnerable and how a bank can actually help their customers navigate through that agenda as well. So there is a lot more reporting coming to bear, and I think it is a hot topic. And we've seen APRA now only recently release a prudential practice guide on this, Tom, and to really help institutions navigate the risks and provide clarity around the risks of climate change as well.
One of the things that has happened, Tim, as you would be aware, in that space, that is sustainability and ESG and whatever have you, is not so long ago the global regulators have urged the development of a single set of sustainability reporting standards. The
Yep.
EIPRS Foundation has picked up the baton and run with it. They've now exposed the constitutional changes to the IFRS Foundation constitution to get the institutional arrangements in place. Now, the main thing, I guess, for people to focus on is what might be the outcome of these processes globally. Are there things people should be thinking about as a new um, non-financial reporting suite of materials starts to develop?
Yeah, look, it's a pretty fluid area, Tom. You've touched on. It's certainly evolving, and I guess what it is about transparency and, in particular, the exposures that organisations face to climate change. Now, partly it is how does it affect the financial metrics of the institution going forward, but also their reputation risks as well, Tom. And we're seeing customers and shareholders be very much attuned into these facts, and therefore including information such as this in a consistent format in statutory financial statements is just going to provide users with far greater transparency, if you like, to make better informed decisions. And particularly around institutional shareholders as well, we're certainly seeing the ESG agenda even widen further. We've had the International Institute of Institutional Shareholders come out at the start of this year and say, look, they're now assessing cyber risk as part of their ESG agenda. So it's not just about environment, and it is about sustainability, and cyber risk is really caught up in that sustainability profile as well.
That's also rather an interesting point. There are other aspects of sustainability that are covered by that term and by ESG more generally. Just to wrap up, and I know I'm mindful of the time, Tim, and grateful you could join me today. We heard a lot about reporting challenges during the COVID period last year. We heard a lot about the need for people to have some disclosure built around various estimates and assumptions in numbers, given the uncertainty of that period. How do you think banks have coped with the reporting requirements over the past 12 months?
Big challenge. If I look at their teams, in a sense, many of these financial reports, people are starting to return back to the office now, Tom. So that's a good news, but that certainly hasn't been the case. The finance teams have been working from home. Executive teams of banks have been working from home. Auditors that audit these financial reports have also been working from home. So, that has been one of the challenges. But I must admit, everyone has sort of risen up to those challenges, Tom, and I think worked through it. But perhaps on the metrics side of things, that level of uncertainty around where the economy is heading and how, we've rebounded pretty quickly in this country. We've rebounded pretty quickly out of the, perhaps what looked like a massive economic shock back in March and April of last year, and then with the extended closures, border closures in Victoria. No one really knew how it was going to play out. So there was a lot of assumptions that went into forecasting what some of those credit losses may be in their collective provisions. As I said, this combination of worst case, best case and base case, but no one really knew. I think what we are seeing, some of that information starting to come to light, but there is still this element of cautiousness. And we have seen some of the modelled outcomes for the collective provision come back, Tom, so they have been released.
Mm-hmm.
But we've also seen perhaps some of those overlays that are used by management and boards to take account of things they just can't forecast, that can't be built into a model. And some of that is the economic outlook. And look, We don't know when the international borders of this country will open. We don't know when international travel will resume, or foreign students, or all of those other things that affect so many parts of our economy. And there are some parts of the economy that are doing it pretty tough. There's no doubt tourism and small business in certain sectors is doing it pretty tough. So, as I said, that's where some of those overlays can provide some of that cushion going forward. There's a lot of judgment in estimating that.
Is there any thing that's coming down the tunnel, if you like, coming up for banks to be wary of in terms of reporting that might be of interest?
Probably nothing that really sort of jumps out on the agenda. There's a lot coming down the pipeline on the prudential side. Tom, we've got CPS 234, which is around information security. That is a big issue as it sort of links very closely into cyber. So that is at the forefront, and that is something the regulators are really focusing on at the moment. ESG we've touched on. We've also got the Basel III reforms that will come in with various floors around certain risk weights for the major banks that are using advanced models advanced accredited banks to predict both operational risk losses and also credit losses. There's a raft of regulatory change coming through, Tom, particularly in relation to design and distribution obligations, unfair contracts in certain parts of their business. Then we've got changes to responsible lending that are foreshadowed. Perhaps that's a loosening of some of the rules. But there is just so much, particularly, I mean, the compliance agenda, Tom, I'd probably say, I haven't seen a period where it's been as full as what it is at the moment. Hence why, the big banks and a lot of large financial institutions and small financial institutions are having to really expand their compliance team and their risk teams to deal with these raft of changes and affect systems as well.
Tim, that's actually an interesting and sound prognosis for that part of the regulatory framework that banks have to play in. Look, it's been great to talk to you again, and thanks for giving us an update on where the financial services system is over the past 6 months.
Oh, you're welcome. Great to chat with you again, Tom. My pleasure.
Absolute pleasure for me as well. Thank you.
Thank you.